Evan, welcome back to the show.
Hey, how's it going, man?
Great to have you back. You're becoming a regular, and I like having you on because you've got, first of all, just a great guy, but second, great mind, great heart, and great house, apparently. Evan Greathouse, so thank you. I want to make sure folks know, first of all, that you've been on our show a few times. And so the first time, I guess, Evan Greathouse was
Like episode 387.
Now 402, and now a little bit later on. So you're going to be, I think, a regular repeat. But there's some strategies that you've brought to my recent attention, Evan, that I think everybody should know about if they have a 401k, an IRA, or just any other built-up, taxable, problematic money. First of all, tell us who you are, what you do, in case folks haven't heard the other episodes, and then tell us a bit about this particular problem you came across in working with one of your recent clients.
Yeah, so I'm Evan Greathouse, and I think I've got a pretty great house. You know, it's fortuitous that is my last name. And I'm a bank on yourself professional, and I've been helping people just learn how to steward what God's given them in truly lasting ways that generates exponential income over generations, has all the guarantees and efficiencies that we love to talk about on this podcast. So, and yeah, there was a client of mine recently. They're from the wonderful Taxifornia state, and high tax state is my point. And they have a lot of qualified money that they're needing to get out. In this particular case, about $250,000. And so what we were facing was...
Just to interrupt, qualified money, that would be like in an IRA or a 401k. Mm-hmm. So that's what you mean by qualified money. So they had about $250,000 in there, and they were needing to get it out, just meaning they got to get it out of the taxable environment of an IRA or 401k. Is that right?
Yeah, after talking with their financial professional, they had determined that they had kind of a tax problem that was going to be creeping up on them if they didn't do something about it. And so what they started exploring were annuities, and they looked at the option of just cashing it all out. They're above the age of 59 and a half, and so they could do that without penalty. However, because it's a traditional IRA, they would have to pay taxes on the whole amount in that 1 year, and that could push them to a higher tax bracket. It could have a lot of implications. But ultimately, they didn't want to pass along that taxable burden to their beneficiaries if something should have happened to them, someday, because if they did, then the inherited IRA for the beneficiaries would be required for them to pull out all of the money within 10 years. And most likely what happens in a lot of cases anyways is that the 10 years that they're having to do the required minimum distributions tends to be in the highest earning years of their life. And so that wasn't a good option either.
Let me just pull the car over for folks just to make sure everyone's getting everything you're saying, because there's a lot of good stuff there that a lot of folks don't know about. You said implications, so this is a big one. Most people might know, you mentioned the 59.5 rule, and most people kind of know something like their 401k is not really accessible until they're at least 59.5 years old. Otherwise, they hit that tax plus penalty. Fewer people realize that if you wait too long, there's a major penalty, upwards of 50% of what you should have took out but didn't. That's what's known as a required minimum distribution penalty. Fast forward then to when you pass away. If you should pass away with an IRA or 401k, listen to this. This is a big deal, guys. Your beneficiaries, a non-spousal beneficiary, like a kid, is now, as Evan was just saying, forced to distribute, meaning take the money out of the tax-protected blanket of the IRA or 401k, and now is forced to pay their taxes on that money at their tax rate. And Evan, you smartly said that usually the inheriting adult children of IRAs are in their 50s, 60s. Whenever the elder parents have passed away, They're now leaving that inherited IRA now to the adult children who are in their highest earning years, like you said, which is going to force the kids, the adult children, to pay more than they should have on that IRA. All of this means the government is taking the lion's share of your IRA. And,
Right.
it's a pity because, the adult children are having to do this. The elder parents are now watching from heaven above, watching the lion's share of their inheritance go to somebody at the IRS.
And I don't know about you, but I don't love anybody at the IRS enough to do that,
Right.
to give them what I've worked hard to give to my actual loved ones.
Mm-hmm.
Yeah, so that's exactly right. So what we ended up wanting to do was we wanted to make sure that they were going to be able to move this money over into a different financial vehicle that would be more tax efficient, give them accessibility to their capital when they needed it. And it's kind of a process, but this was an efficient process that we came up with to do something called MYGA laddering, which a lot of other people might have heard something like CD laddering or bonds laddering, something along those lines, where you have timed, investments that have market guarantees and so on that mature at a certain point in the future, and in the meantime continue earning interest. Well, a MYGA has some other benefits because it's a life insurance product, and MYGA stands for Multi-Year Guaranteed Annuity. And that allows people to have kind of the same thing as like a CD would offer, except there's some other benefits like not having to pay taxes on the growth each year, like having a guaranteed ability to access in some cases like 10% of your money without any penalty, and a lot of flexibility in renewing that as well too. So
Just for folks that are just totally brand new to this, I'll just underline what you've already shared and also point people back to episode 280 of our podcast, where we really kind of introduce the MYGA character on the theater scene here. But you're right, MYGAs are the CD killer, in my opinion. They do what CDs are supposed to do, but they do it better. They usually have higher rates of return. They, engage your money for a certain set period of years, like 3 to 7 years. You get to pick your terms and how long. I've even seen 2-year MYGAs, but they're supposed to be for a year or 2 or 7 or 10. And usually there's different declared interest rates, like you said, that are guaranteed for the life of the contract. So even if interest rates fall, and who knows where they're going to go from here, from this point forward in our economy, you've locked in a high rate that you just wouldn't have with a savings account that's going to fluctuate every month or whatever. What does it look like to transfer the IRA funds into this scenario or strategy you recommended to them?
The game plan was to take the $250,000 and ladder it into these MYGAs. In this case, it was going to end up being about 5 different MYGAs. And what their plan was to do was they're going to take their IRA and transfer $50,000 each into each MYGA, which a MYGA is basically, it's an IRA that holds an annuity. And so it's a transfer from an IRA to an IRA holding an annuity in it. And that's going to allow you to transfer that money into a different financial vehicle without any penalties or taxes or anything being due at that time.
So it's really not any more complicated than doing if I've got a Schwab IRA, I could transfer it to a Ameriprise IRA or some other Fidelity IRA, and it's just transferring from one financial institution to another, right. And I'm choosing what to put in my IRA. You can have gold and real estate or stocks or crypto in IRAs, but you've chosen a MYGA here, and you've opened up 5 different accounts. That seems complicated. Let me play devil's advocate. Why do 5? Why not just throw it all into one big bucket?
Good question. Well, so MYGAs mature and eventually, and you can set the maturity date to be usually at least 2 years, or as many as like 7 plus or 10 plus even. years. And so in this particular case, these clients have the first 2 years of premium covered on their existing whole life policies. So we need the first MYGA to mature in the third year. Then they're going to take the money that they receive after the MYGA matures and the annuity pays them all of the $50,000 that they put into it, plus any earned interest. They're going to have to pay taxes still. I mean, there's no way to get around that. The government is going to take their pound of flesh. And after, the remainder of the premium that they receive from the MYGA is going to be used to pay the third year premium on both of their policies, their bank on yourself policies. And then so on. When the fourth year comes around, they'll have another MYGA that's scheduled to mature in year 4. That'll pay out. They'll pay any taxes they have to do, pay. And then year 5, year 6, year 7. And this is going to allow them to spread out their tax burden instead of taking it all out in 1 year, because in this particular case, because they're in a high tax state and the tax bracket that they're in, they were looking at paying like $60,000 plus in taxes if they were to pull out everything all in 1 year at their current income rate. And so that wasn't an ideal scenario. And this is going to allow that to be spread out over time. It's going to allow them to guarantee it from market risk, and it's going to help pay their policy, their whole life, bank on yourself whole life policy premiums with certainty, knowing that they're not going to ever find themselves in a scenario where they can't pay the premiums.
So this MYGA laddering is almost working like a complement to the bank on yourself strategy, in that you're using this almost like a tax efficient bridge between the qualified world, the tax deferred IRA world, into the after tax or even tax free world of life insurance. So you're doing a couple of really smart things there, Evan. One, your client is avoiding having to pay so much in tax by spreading out the tax burden over a number of years. They're slowing that pain down and keeping under a certain radar of the IRS. And then second, by funding their life insurance over a couple of years, rather than just smashing it all into their policy in one lump sum, they're keeping it outside of the MEC limit, which is another way to tax a person is through MECing a policy. What is a MEC policy for folks that aren't familiar with that?
Yeah, the modified endowment contract. It's not to be mistaken. It still is life insurance, but the modified endowment contract is taxed and treated differently as far as taxes are concerned. And most of the tax efficiencies end up going away if a whole life policy is a MEC policy. They're not inherently bad. They can be used strategically for certain things, but in general, with a bank on yourself structured policy, you're going to want to try to avoid a MEC policy. So this is allowing them to pack in the $250,000 plus any interest that they're able to and fund over and above up to the MEC limit really, really quickly, efficiently. And then by the end of the funding phase for these whole life policies, they will have transferred out the $200,000 into a technically tax deferred vehicle still, but it is tax free accessible.
That's a good way to put it.
And through policy loans. And then also when the benefit pays out someday, when these two people pass away, the beneficiaries will get that death benefit tax free and not have to pay taxes on that. So that's a really incredible thing, especially for this particular couple, them being in a high tax state. So.
We did a similar episode. I'm looking back on our archives. Go back way back to episode 121, guys. And we talk about a similar strategy there, but what you've brought up is the MYGAs, which provide a guaranteed rate of return. And in all of the volatility of our world today, it's nice to have something that's guaranteed. Who do you feel like would be a good candidate for this laddering MYGA strategy? And then also, who might not be a good fit for this strategy?
Yeah, great question. I think this really does make a lot of sense for people who need to transfer a large sum of money that is in a tax inefficient tax vehicle, and they can also, benefit from the accessibility to it as well. That's another huge thing, is just being able to access your money when you need it on your terms, without having to calculate taxes and things like that. That makes a lot of sense for those types of people. Anybody who really wants efficiency, this is going to be a good strategy, and has a large sum of money that they need to transfer.
In this case, they're comfortable spreading it out over a couple of years. So for folks that need all their liquid money right now, it probably would not be a good idea to spread things out like this. You may just have to bite the bullet and pay the tax man, but then that money is yours and in your hot little hands. But if you can be patient a few years, it can be an incredibly powerful tool, a great efficient tool to spread that money out. Let me tell you a very quick story, Evan. We had someone who, I shared something like this. It was not the MYGA laddering, but it was sort of like this. We chose to do a SPIA, which is a single premium immediate annuity, in an IRA, just like you're sharing there, and it would fund her life insurance over an 8-year period, similar. Now, there's some other complications there, but she chose not to do it. She chose just to do the life insurance, but kept her 401k money in the stock market. And her game plan was to pull that money out as she was already retired to spend into the life insurance, moving it from taxable 401k to after tax or tax-free life insurance. Well, what happened? Well, she lost about 25% of her money due to a market madness moment, and she freaked out. She could not believe it. She had lost so much of her money, and she was too scared. Then at that point, she was already too scared to continue to fund her life insurance, because she had lost so much in the 401k. So not only did she lose the money in the 401k from the market's craziness, but now her life insurance funding plan was at risk too, all because we left this to be a manual transmission strategy where we were hoping and praying. She was hoping and praying to the market gods that she could take it for 8 years and get a slightly higher rate of return than the SPIA or the MYGA could give her. Don't do it, guys. Guarantee your plan will work. Otherwise, it's not a plan. It's a hope. It's a prayer. It's a strategy. But it's not a plan until there's some contractual guarantees. What we just shared on the MYGA laddering is that KNOW, that your plan will work and that you'll be able to have a fully funded life insurance policy. Use a SPIA. Use a MYGA laddering strategy. Use a fixed index annuity that pays out over a number of years. That's a great idea too. Would you comment on any of that, Evan, or any feedback on that story or other insights from that?
Yeah, and in this particular case, we looked at lots of different options. Ultimately, there were a couple of other strategies, but this one actually, because MYGAs actually have very competitive interest rates at the moment, they change every week and month seemingly. This was going to give them the greatest guaranteed interest, that they could count on over the next 5 to 7 years as they're waiting for each of these MYGAs to mature. And that, to me, is probably the best bet. And it could be a different case in the next year or a few months from now. But for these particular people, this was going to be the best route for them. And you made a point earlier I wanted to make sure I hit on. This particular client, they have plenty of cash flow. And what they were needing to do, another huge reason why they're doing this strategy and getting the money into a bank on yourself type policy over the next 7 years, is because they need liquidity as well. So there's a lot of benefit. And I know you've done some podcast episodes. You can probably pull those episodes up about the importance of having not just cash flow, but access to liquid capital, a large portion. Should you have an emergency, or should you have a family vacation you want to take everybody on and pay for that, and you could take policy loans, you could purchase vehicles or cars or down payments on houses. There's lots of different things that you're going to need, obviously. A nice pool of accessible liquid capital and money to get to. So that to me was another huge point in why they were qualified to do this. Cash flow is there. They don't need this money right now to live on. They did not have to have full liquidity to all the $250,000 and access to that. This was something that they are qualified to take their time rolling into. This was a really important thing for both of them. Ultimately, the husband really wanted to make sure that his wife was taken care of in the event something should ever happen to him, and vice versa. Obviously, it seems like a lot of cases, it's the husband who's concerned about making sure the wife's provided for. And in this case, that was the case. So that gave them a lot of peace of mind, knowing that, this is not going to be complicated. It's on schedule, and it's going to happen when it is said it's going to happen. And you don't, I guess, let me ask this kind of rhetorically. Do you have to cash out the money when the MYGA is going to mature? The answer is no. You don't have to. You could just roll it into another MYGA for another 3 to 5 years, however long you want to, and kind of keep that rolling along. That way, let's say that they're able to make their premium payments out of pocket without having to use the MYGA. They can just let that continue to grow and earn interest, and let it be a benefit to their beneficiary someday if they wanted to.
And my bet is that the death benefit on those life insurance policies was more than, if you added them up, more than the original pre-tax $250,000 that they had in their IRA. I don't know, but I'm guessing.
Yes. Let's look. I don't have the numbers in front of me, but I can safely say that indeed, yes, that is the case. Their combined death benefits were going to be a lot more than the whole amount.
Think of what happened there. You took a taxable $250,000, not guaranteed, moved it into a income tax-free, guaranteed benefit to the family, and you did it in a way that systematically got them out of the markets and moved them out of the taxable world as well. That's a genius move there, Evan. When did you realize you had a passion for this sort of thing?
I realized it one day. I was out doing some yard work, and I was actually listening to this podcast. And I found myself just dreaming about different ways that I could do this strategy for not just myself, but, I was even thinking of, plans for family members, and just trying to get creative and think outside of the box. Just that's kind of how my brain works. And when I realized that I had a knack for it, even without much training, except for, what I got out of this podcast, which is tremendous amount of training, actually, it helped me out a lot, because I got to finally do something that I felt like God put me on the earth to do. So
very cool.
Yeah, absolutely loving it.
Well, and you're helping families solve complex issues like this one. This is just one example of what you've shared with me in our private meetings to help serve your clients. We do a little work together and try to help each other out. And the creativity of coming up with, hey, what's the right way? What's the best way to move from plan A, where we are today, to plan B, which is the hopefully better plan for most families. That takes a lot of forethought and creativity, and also, most importantly, listening. I feel like you have all those things in spades, Evan. So maybe share just briefly a bit about how you work. What's your process like with clients? How do you typically manage your relationships with folks? Like, what are your conversations like? And then how could folks reach out to you if they wanted to learn more about what you could offer them?
Yeah, great question. I always start out just with a quick introductory phone call, 15 minutes or so. And I just want you to, one, get to know me, and then I want to get to know you a little bit as well. And the main purpose of that call is also to just quickly determine whether or not I think it's worth it for you and for me to continue the conversation. I can usually find out whether or not this strategy is going to be something of value to you. And if it is, then I'll let you know. If it is not, I will let you know that too. And we can go through the next steps, should it be a good thing for you to do and pursue. That is when we will do a financial analysis, and the 30,000 foot up view of your entire finances is going to be the next step. Because like a doctor, I need to be able to see all of the data to diagnose and figure out a solution to whatever we're trying to accomplish. And then after that, you get to see how the plan comes together. I build out a custom tailored solution exactly, to suit each individual person or couple's needs, or family in some cases. And what we're going to do with that is, if that looks good, if everything that I go over with you looks like, yes, it's a no-brainer, then what we'll do is the application. So easiest way to get in touch with me and start those conversations is just email me at evan@greathousefs.com. That's evan@greathouse, F as in Fox, S as in Sam.com. Or you could just reach out and call me. I know also Mark is going to be able to put a link to my calendar directly into the show notes, and you can click that link and schedule that 15-minute introductory phone call at any available time.
Evan's one of those guys you're glad when you know him. And you're glad to know him. And he's one of those guys when you need a guy, when you know a guy, you got a guy. And that's Evan Greathouse. So Evan, thanks for your friendship and your companionship in the journey of our businesses together, our colleague work together. And I look forward to hearing all the wonderful ways you serve clients for years to come. So thanks for coming on our show today.
Absolutely. Thanks, Mark.